As described in a previous video in the series, one of Wall Street's functions is to assist issuers in raising capital. The investment banking underwriting division handles these capital-raising efforts for most firms. Let us first examine some of the language associated with these financing transactions, and then move on to the federal regulations. Capital formation. When a corporation intends to raise capital, it usually sells stocks and bonds through a formal offering. The nature of these offerings varies depending on the type of issuer and the investors involved. Certain issuers, like corporations, are subject to federal regulations when they issue securities, while others, like the U.S. Treasury, are exempt. Securities may be offered in two ways: public offerings and private placements. The primary advantage of a public offering is that an unlimited number of investors are permitted to participate. However, the disadvantages include regulatory costs, legal and accounting expenses, and time required for disclosure requirements. Institutional investors like pension funds, insurance companies, and venture capitalists provide startup capital to new companies. The capital is raised through a non-public offering referred to as a private placement. Private placements are faster and less costly than public offerings, but may have limits on investor types and numbers. When an issuer offers securities to the public for the first time, it's called an initial public offering, or IPO. If a company has already gone public and raises additional capital through common stock, it's a follow-on offering. These post-IPO offerings are still primary distributions where deal proceeds are paid to the issuer. FINRA. Rule 2269 requires disclosure when a member firm trades existing shares while seeking investors for new offerings. FINRA rules mandate written disclosure for trades involving securities where firms have distribution participation or financial interest. In a combined offering, some shares are provided by the issuer, while others are sold by selling shareholders. Company-sold shares are newly created, represent primary offerings, and increase total outstanding shares with proceeds to the company. When existing shares are sold by current shareholders, it's a secondary offering with proceeds to selling shareholders. If the offering is split, underwriters must inform purchasers that some proceeds go to selling shareholders. Selling shareholders include company officers or early investors looking to cash out or reduce their holdings. An underwriter acts as a broker-dealer that assists corporations or municipalities in raising capital. When underwriting, an investment banker takes risk by purchasing new issues and reselling to the public. The investment banking role connects issuers with potential buyers for new funds or refinancing. Public offering sales are managed by a group of broker-dealers known as an underwriting syndicate. Syndicate member responsibilities depend on the type of underwriting agreement. If a syndicate buys the entire offering and absorbs unsold securities, it's firm commitment underwriting. The syndicate commits firmly to the issuing corporation for the full amount of the offering. Regardless of sales ability, the syndicate acts in a principal at-risk capacity. For instance, if a corporation sells 10 million in stock but syndicate sells only 8 million, syndicate members absorb the 2 million unsold. In best efforts underwriting, the syndicate commits to sell as much of the new offering as possible. Best efforts underwriters operate as agents, finding purchasers, rather than acting as principals. For example, a corporation wants to sell 10 million in stock, but underwriters can only sell 8 million. In best efforts underwriting, only the 8 million will be issued, and unsold portion returns to issuer. Sometimes a corporation requires a specific minimum amount of capital to be raised. The issuer may determine that raising less will be insufficient to accomplish its objectives. If the minimum contingency is not met, the offering will be canceled. One contingency is the best efforts all or none arrangement. Similar to best efforts, underwriters act as agents attempting to sell as much as possible. However, if the entire offering isn't sold, all sales must be canceled and money returned to subscribers. Another variation is the mini-maxi underwriting. There's a minimum threshold of sales that must be met to avoid cancellation. Once minimum is met, additional sales may be made up to a specified maximum amount. For example, a corporation intends to sell 10 million in stock. Based on capital needs, it requires at least 70% of the offering be sold. Therefore, a minimum of 7 million must be sold, or the entire issue will be canceled. Once minimum is satisfied, underwriters continue selling remaining 3 million without cancellation risk. If a corporation sells additional shares, it may conduct a preemptive rights offering. Current shareholders get rights to purchase additional shares at a discount before public offering. Due to concern that shareholders will leave rights unsubscribed, issuers arrange standby underwriting. In standby underwriting, the syndicate agrees to purchase any unsubscribed shares remaining after rights offering. Standby agreements are executed on a firm commitment basis. Market out clause. If the written agreement entered into by the underwriting syndicate and the issuer contains a market out clause, the syndicate may be permitted to cancel the agreement. The justification for canceling the commitment is based on certain events occurring that make marketing the issue difficult or impossible. Examples include a material adverse event affecting the proposed issuer or a general disruption in financial markets. Shelf registration. Certain issuers of existing publicly traded securities can utilize a form of registration that enables them to sell additional securities on either a delayed or continuous basis. This process, known as shelf registration, is permitted only for an amount that can reasonably be sold within 3 years following the initial date of registration. The advantage of the shelf registration method is that the issuer can complete all necessary paperwork in advance and be ready to market the shares to the public when conditions are most favorable. Distribution of securities. A broker-dealer considering the possibility of becoming the syndicate manager in a distribution of securities must perform due diligence on both the issuer and the issue. This due diligence process involves examining the issuer's history, the quality of the company's management, labor relations, financial and operational data, legal matters, and comparable companies in the same field to assess the viability of the distribution and the appropriate price at which to offer the securities. Syndicate. If the syndicate manager is interested in collaborating with an issuer, it will then form a syndicate by inviting other firms to participate in the distribution and share the liability. The written agreement between the manager and syndicate members, known as the syndicate letter or agreement among underwriters, is signed by the participants and specifies each firm's rights and obligations. The role of the syndicate is to guarantee underwrite the offering. A broker-dealer's syndicate desk assists in pricing the offering, helps build the book of orders, markets, distributes the issue, and, if necessary, places a stabilizing bid. Selling group. In some cases, the syndicate will recruit additional broker-dealers to assist in the distribution. These firms, known as selling group members, do not assume financial liability for the offering. Instead, they act as sales agents. Any shares that are not sold by the selling group are retained by the syndicate, since the syndicate members remain financially liable for any unsold shares. To join a selling group, a broker-dealer must sign a selling group agreement that outlines the relationship and responsibilities between the selling group and the syndicate manager. The underwriters and selling group members are collectively referred to as distribution participants, determining the public offering price. For a primary offering, the price is fixed and applies to all sales made to the public. To determine the price of an IPO, the underwriters consider various factors, including corporate earnings, dividend payouts, the prices of similar companies currently trading in the secondary markets, indications of interest, and current market conditions. For a subsequent offering, the underwriters typically set the price at a small discount to the current market price of the existing shares. Underwriting spread. The term underwriting spread refers to the difference between the amount paid by the investing public and the amount received by the issuing corporation. The spread represents the syndicate's gross profit. Depending on how the shares are sold, the spread may be shared by the manager, syndicate members, and selling group members. To avoid overwhelming you with long videos, we'll keep it brief and easy to digest. Join us for a follow-up video where we will continue the discussion from the previous one. As always, please like this video so others can benefit as well. If you are a new viewer, we invite you to join our family with a free subscription.